Welcome to the channel. For today's stock, we'll be looking at Enphase Energy. They're in the renewable energy field, focusing on inverters and batteries. This is a stock I do not own, but with the recent stock price drop, becoming a little more interested, though still above a price that I would like to buy in at. You Enphase bulls, you might not like the valuation I'm about to give, so be prepared. But first, we'll look at their financials, then roll into the valuation, look at the recent stock price action, and then at the end, we'll go into machine learning to look at their 52-week stock prediction. So with that, let's jump right into it. Here's Enphase's financials for the past 10 years. And one thing that sticks out right away is back during these earlier years, 2013 to 2017, these numbers are relatively low compared to the past couple of years, and particularly net income was negative. Obviously, earnings per share were negative as well. Even free cash flow back then, except in 2014, which was positive, but negative those other years. So this is a stock that actually went public around 2011, 2012. So this is not unexpected to have these lower numbers back then. But these recent years, 2019, 2020, and so forth, you can see these numbers have picked up for revenue, net income, earnings per share. So this is nice to see. Yeah, earnings per share and income were a little lower in 2020. COVID probably had something to do with that, but still looking like a nice trend over the past couple of years. Dividends. So obviously this is an early stage company, so I don't expect them to pay any dividends. Share counts, not uncommon for a early stage company to be issuing more shares. So not something I would normally like to see, especially in a more mature company. But for Enphase, still in their early stages, I can let this slide, though I would hope in the near future they stop diluting shareholders and at least stay relatively flat. Maybe start buying back shares, which they have mentioned in the recent earnings call. But still, something I would watch, but not overly concerned based on their current stage. Book value, you can see book value has been nicely increasing since 2018. 2021, yeah, slightly down, but showing progress. And then free cash flow, we can see here, it's been increasing basically since 2017. So that's a good sign. So another data point I like looking at is this return on equity. But we can see here back 2013 through 2016, it's negative. That's because they had negative net income, as we mentioned a few minutes ago. And then it jumps up to this ridiculous values back in 2017 and 18, well over 1,000%. And that's because they had this negative net income, minus 45, minus 12. And also during this period, they actually had negative equity too. And so it's just throwing the calculations off. So I wouldn't even take these into account. And really, I would just be focusing on these last 3 years, 2020, 2021, where they were in the low to mid 30s. And this industry they're technically in, which is semiconductors, averages more in the mid 20s. So doing very good compared to the average. And then it did jump up significantly last year to 63%. And we can see here the last 2 years of net income, almost 400 and about 150. So that's probably why it's throwing this most recent year, 2022, so high. But a data point I'll be looking at more closely moving forward as they probably start leveling out to more realistic numbers. And since the net income and free cash flow from 2013 through 2018 doesn't really represent where the company is today in terms to their returns, I'm going to remove these values so it doesn't impact the discounted cash flow method I'm using to evaluate the stock price. So let me remove these, and this would greatly help evaluating the stock to give it more of a realistic price for where the company is today. And also scrolling down a little bit, I'm going to look at some of these values on a chart. And we can see here revenue per share. Not taking into account those earlier years, but looking at the maybe the last 5 years or so, we can see it's starting to trend upwards. So even though they've been diluting shareholders, still this white line has been increasing as their revenue has been able to outpace the dilution in shares. Uh, as we saw before, book value that's been steadily increasing. Increasing, we can see that in red. Free cash flow per share also has been increasing. So they're starting to show these signs that I like to see in the stock, moving up and to the right. In the middle of the graph in orange is return on equity. And as we discussed a few minutes ago, back, I think it's 2017, 2018, had these ridiculous values over 1,000%. One year was over 1,500%. So I don't take these into account as being realistic. And it's more in the past couple of years where it's in that low to mid 30s. Yes, last year was quite higher in the 60% range, but I would predict that in the future it's going to be more in the high 20s to 30% range, and what I would be looking for moving forward. With that, let's move on to the actual valuation of the stock. And just to give some notes here, there's a light green area. So that's the actual discounted cash flow method being calculated. And as of today, September 12th, the stock closed just over $123 a share. And what I have entered already for a short-term growth rate of 10 years is right here, 24.5%. And that gives me about $125 a share. And I did that just to get close to what the current stock price is trading at. I will say the net income CAGR. So based on like the last 5 years for net income, it's growing at about 35%. And both of these, this 24.5 and 35, are a lot higher than what I like to use for a short-term growth rate. I really don't like to go too high. So what I'm going to use is 15%. I like to be conservative with my evaluations. So I'm going to change this to 15%, and we're going to see these numbers change down here for the intrinsic value. And with the short-term growth rate of 15%, we see the intrinsic value drops to just over $84. And then using a 70% margin of safety, that comes out to just under $59 a share. So that's like the range I'm looking at. Ideally, I like to get 59 or lower, but I can see myself buying into this stock actually between this 59 and $84, depending on how the market's doing and how the stock price is doing. And again, that's using a 15% short-term growth rate for the next 10 years. And I like to use a 3% perpetuity growth rate thereafter. Some other data points I like to look at are here in blue. Now, I can tell right away return on invested capital. You can see past 5 years, year over year, averaging like 20%. Over the last 10 years, you can see it was kind of negative, but we already discussed those earlier years. But book value, you can see book value has been growing pretty much steadily. Not sure why the 5 year is not populating. Growth rate for earnings per share, we can see here past couple of years, it's been growing. Sales has been growing over the last 10 years. So these are some good data points I like seeing. Long-term debt to free cash flow, nice sign. I like to see under 3, just over 1.7. We already discussed they don't pay any dividends, but the share counts increased almost 250%. So it's one of my big concerns. So hopefully they start leveling off. And I know, as I mentioned, they recently discussed in the quarterly earnings that they are going to look at buying back shares. Net profit. So over the last 10 years, 1%, but really the last 3 years, averaging 15%. So I'm seeing some good signs here for Enphase and something or a stock I would like to buy into, but again, at the right price. With that, let's jump over now to the computer modeling so we can do some forecasting on the 52-week stock movement. Here we are in the computer modeling software, and I already ran the forecasting for 2 methods just to save some time. And this method that we're looking at is the M5 rule. And right here, September 11th, this previous Monday, the stock closed at 122.19. The far right column, the column right next to it is just the S&P 500 index. And then these other columns to the left are just other data points for Enphase. And scrolling down, just looking real quick, it is showing a continuing to drop in the stock price as we've been seeing over the past couple months, but then ticking back up around Q2 of next year, going into Q3, and actually out in 52 weeks, uh, closing at around $153, $154. So M5 rule is showing a continuing decline, but then picking back up next year. Uh, Now, let's jump over to the random forest, which is typically more bearish, but looking here, they're actually showing more of a bull run. So again, here's the stock price September 11th, closing at 122.19, and random forest is showing more of an uptick for Enphase going into next year and actually out 52 weeks and closing at around $220, which was about the stock price earlier this year. Now, what I like doing is taking these two methods, the M5 rule and random forest, and averaging them out. So let's move over to Excel so we can look at this average on a graph. Back over in Excel, I already pasted the results for both the M5 rule and random forest. So we can switch over to the next tab. And here we're looking at the graph for the M5 rule. And the vertical red line, that represents this previous Monday, September 11th. And the blue line is the stock price. So everything to the left is the historical stock price, and everything to the right of the red line is the forecasted. And the orange line just shows the percent change moving forward for the forecast. But as we can see with the stock price recently, starting in about October of 2022, it has been on a steep decline. And as we saw in the computer modeling software, it was showing that decline to continue until early next year and start ticking up. So if we project out 52 weeks, though it continues the decline, is actually showing a 20% gain by this time next year. And if we switch over to the random forest, it shows an immediate rebound in the stock price as we saw in the computer modeling software. So random forest is being a lot more bullish on Enphase and projecting it to start increasing relatively soon. But I like to take the average of both as opposed to just looking at one of them, as typically one method is usually a little more bullish while the other is a little more bearish. So let's go over to the average. Looking at the average for the two methods, it's showing a pretty flat couple months moving forward, and then early next year having a small decline, looking at getting to about the $110 range, and then beginning to tick up and ending the 52 weeks actually on a high note from where we are now, looking in the high or 180 range. So showing about a 50% increase from where we are today, trying to rebound from the declines over the past year. So to recap, the M5 rule is showing a continual decline in the stock out the next couple of years, actually into early next year, and not showing a recovery into about that Q2 time period where it's showing a nice bull run, regaining the losses, and actually having a 52-week gain of about 20 to 25% from where we are now. While the random forest is showing a recovery a lot sooner in the next couple of months, or actually maybe the next couple of weeks starting off, and actually having a very nice bull run into next year, looking out 52 weeks. Actually, I think it was in almost 70% range. So getting closer to regaining those losses this stock has had over the past year. And the average that we just looked at showing obviously somewhere in the middle. It's not going to have as much of a decline as the M5 rule is, but still going to show a decline with the stock hitting maybe about $110, while the M5 rule had the stock hitting in that $60 range where I really would like to buy it. So for me, I'm going to wait and see how everything plays out for the next couple of weeks, or maybe until the next quarter returns. I believe their next quarter reporting is in October, so in about a month or so. So maybe I'll wait to see how that plays out, give me a better idea on the stock movement. But the average is showing also a recovery, and out in 52 weeks, recovering to about $180, which should be about a 50% gain. So hope you enjoyed this analysis and forecasting. If you got any benefit from it, think about subscribing, and hopefully I'll see you next time.